Hi guys, welcome in everybody. Thank you for taking the time to invest in yourself. If you weren't here for the one earlier this morning, I hope it went well. If anyone has some positive, negative comments from the morning session, keep it to yourself. No, I'm just kidding. Tell us, tell us if there's anything you want to say before we get started. We'll give people 3-4 minutes. Hopefully it helps people. It's not that complicated once you do it a couple of times. So if anyone wants to unmute themselves, tell us a little bit about themselves. I'm happy to learn about people and what are they investing in? Where are they investing? Ryan was just telling us he just goes on a short-term rental, Ryan.
I bought a long-term rental last Friday and under contract on a short-term rental now.
Okay.
So I'll do, if I can get the mic and get the floor, I'll do a sneak peek of what we're gonna be talking about tomorrow for you guys that are in there tomorrow. But I have a calculator. You guys can actually find it on my website if you go on to learnlikeacpa.com. So I have an Excel sheet that it is used to determine profitability of a short-term rental. And you could do the same thing with long-term rentals too, right? But what this calculator does is very quickly with the green inputs, within 5 minutes, I'm able to know if a property is going to cash flow or not. And this is what allows me to kind of make a better decision. Am I going to move forward with this property, et cetera? And interesting, this property, it is a 36% cash on cash return. Okay. But when I factor in some of the tax benefits that we're going to be talking about in tomorrow's boot camp, it turns my 36% cash on cash into a 65% cash on cash because of the tax savings, because I'm able to add back the tax savings to my total cash flow from the property and make my cash on cash 65% in the first year. So just a sneak peek of what we're going to be talking about tomorrow. But
That's insane. That's so crazy. I've been talking to a lot of clients or new clients who have no idea, who've never done a cost segregation. And it's crazy that some people don't even know about that. And it's okay, right? Education gets you further, but I'm sure you're on the same page with your clients, Ryan, where we just go back and amend the returns because it's so worth it. It's worth to spend that couple $1,000s between us and the cost segregation specialist to be able to get refunds. So this is all we're going to be talking about tomorrow, reps and everything. So we still have about a minute, so feel free if anybody wants to just chime in. And then this one will be shorter, which will be good because it will allow us to ask more questions. The one this morning was really detailed because there's a lot more detail that needs to be reported from a long-term or short-term rentals property way for tax purposes. But this is for businesses. Businesses are a little easier to take care of, except flips. We're not going to really dive 100% into flips. That would take us probably 2 hours just in itself. We'll see how the demand is after next week. If someone wants us to do just a boot camp for flips, that is very, very in depth. But it's worth it. So if anybody doesn't want us to raise their hand before we start, I'm happy. If not, we will just get started and we'll go from there. All right. Z, why don't you just start sharing the knowledge?
Yeah, I can get going. Okay, so let's start here. Okay, great. We all can see QuickBooks, yeah?
Yes.
Okay. So this, if you were here this morning, is going to be very similar to this morning, except we're doing a service industry business instead of a rental property. So I'm going to start out. You can use any version of QuickBooks for this type of business. If you're just self-employed service business, it can be anything. So we're going to go over the banking tabs. We're going to talk about vendors and how to file 1099s. We're going to talk about your reports, and we're also going to go into this accounting tab where we can reconcile our accounts and look at the chart of accounts. So that's where I'm going to start first, is the chart of accounts. So this business specifically is an insurance broker. So they don't have any product on hand. They're just selling a service. So I've added some things that they use. I've added all of their bank accounts, their credit cards. They have some loans here. We have their services, which is their income, and then some expense accounts down here. If this is set up from the beginning, QuickBooks is just going to kind of give you what they think you need, and then you can add and make things inactive from there. So if we're going to add an account, we're going to go to this new on the right, and the account type at the top is the most important. So this used to default to bank accounts, and we would have, 20 wage expense as a bank account, and that's just not how it's supposed to be done. So it's really important to choose the right one. Income is going to be all the money coming in from the product you're selling, the service you're providing. Expenses is going to be most of your stuff, everything all the money you're spending to, run your business. Banks is just going to be checking in savings accounts. Assets, an example would be if you have a big machinery you use to, produce the product, or if you have a business vehicle you use 100% for business, we would add that. Credit cards is self-explanatory. Liabilities is going to be any loans that your business owes other people or a financial institution, and then your equity accounts. This one is really important because if you are by yourself, it's just you, this is a single member LLC, QuickBooks is going to give you 2 accounts. It's going to be this owner's pay and personal expenses and owner's investment. If it's just you, those are totally fine. We don't need to add anything because you're the only owner. We don't need to separate anything. But if you have a partner, you need to each have your own equity account. So let's pretend in this example that me and Anna are partners. I would go to new and add each of our own equity accounts. So I would choose equity. I would just choose this general equity. Most of the time, this is what you're going to use, is just the general whatever. If we were to go to expenses, it's just going to be general expenses. So we're going to go to equity, general equity, and choose owner's equity. And we're going to have a capital account for me, or equity account, whatever you prefer to call it. And then we need to also add one for Anna. So we're going to do the exact same thing. Go to new, equity, owner's equity, and say Anna's capital account. So that way, when we look down in our chart of accounts in the equity section, anything that I'm contributing is going to go, or taking out of the business is going to go into my capital account, and same with Anna's, so we can keep track. So if you need to edit an account, we are going to, so we have donations here, and it's under advertising and promotional. We know that that's not correct. So if you want to edit it, you just hit this little arrow and go to edit, and then it's the same screen that pops up, and you can change any of this. I like the first to be capital, and this is actually charitable contributions, not advertising. And it's going to say, hey, this is going to change where this is on your financials. Is this okay with you? And you just say yes. 2 other accounts that is really important to have if you have any large assets you're adding is accumulated depreciation, which is a fixed asset, and the detail type is accumulated depreciation. And then you also need depreciation expense, which is weirdly under other expense. This detail type is less important than the actual type because this doesn't show up on your financials, but the fixed asset is going to determine where it is on your balance sheet. So that's really important. This specific business has payroll. I'm not going to go too much into payroll, except to say that if you are going to, if you're an S Corp, say, and you're running payroll for yourself, it is going to be the most convenient for you to run payroll out of QuickBooks. You set it up here. You can set it on auto pay to pay you, twice a monthly or biweekly, monthly, whatever you want. And then the last thing I'm going to show you about the chart of accounts is if you want to add a sub account. So say that this business really wants to specifically know how much they're spending on specific types of advertising. So if we go down to the expenses, you can see we have advertising and marketing. But if we want to know how much we're also spending on direct mail to clients, phone calls, say Facebook or Craigslist advertising, we can make sub accounts of advertising expense so that we can see it as a whole, but we can also break it down. So to do that, we would go to new the same way. We would choose an expense, and instead of choosing this general expense to make it a sub account, you would choose advertising and marketing. Then this next one is going to just be whatever you chose for advertising and marketing, since they're the same. And we would say direct mail here. We can save that one. We can add one for phone calls. So we go to expense, advertising, and say phone calls. So then when we scroll down and look at our chart of accounts, these ones are a little bit indented, saying like, hey, this is like the parent account of these two sub accounts. So once we have our chart of accounts all set up the way that we want it, we need to connect our bank accounts. So that's going to be on this banking screen here. So this business already has all of their accounts added, but if you're starting out from zero, it's not going to have anything here. So you need to link your account. So to do that, we just click on it and you're going to search for your financial institution or your credit card company. So say that you have Capital One, you can click here, or a smaller credit union, you can search for it. It's going to pop up with the either the bank website if it's a bigger lender, and it's going to ask you for your password and your username. It might ask you for an authorization code, but you put all that in, and then it's going to also ask you when you want to connect your account as of. And this is really, really important, mostly for credit cards. So if you connect a checking account, it's typically you're going to want to connect it as of the first of the month, which is the first day of that billing period or statement period. 9 times out of 10, checking accounts start on the first, they end on the last day of the month. They're easy. For credit cards, depend on when you opened that account. So it could be the 13th of the month is the first day of that billing period. You just need to go find a statement, figure out what the first day of any billing period is, and choose to import the transactions as of that day. So that way you're starting on a clean slate. You're not doing half of a statement, half of another one. So anytime I'm in this screen, I always just hit this update button. This is going to make sure that QuickBooks is pulling all of the most recent transactions from your bank. You can see it was last updated 23 hours ago, but if this is, the first of the month and we go to reconcile, there might be a couple things missing. So we want to be sure we hit this update button. Now it was moments ago and we actually just got 2 new things. You can see because it was 10, now we have 12. So when transactions are here in the banking section, they're just kind of in the waiting room. They're not reflected on your financial statements until we choose a category and add them. So if we were to go to reconcile, none of this would be there. If we would go to run a P&L, none of this would be factored in and our net income would be overstated. So to add the transactions to the to the financial statements, we need to review each one and add them. So I am just going to start at the top here. There's just a few. Let's see. Let's actually start with society insurance, right? This is an insurance expense for this company. So you can see in green, QuickBooks thinks it's other business expense. Sometimes QuickBooks gets it right because they're just guessing, right? They don't know. Sometimes they get it right. Sometimes they get it wrong. So we're going to change it to insurance expense. The vendor customer is optional, except if you're going to be issuing a 1099 to this payee. I'm going to get more into 1099s later and I'll come back to this, But if you're going to send someone a 1099, you need to be sure to enter their name in this box here. So we have the categories, so we can go ahead and add this one. The next one is the payment to her SBA loan. QuickBooks got that right because that's what we put it as every time, is the SBA loan. So we're paying that down and we're going to hit add. These next two are deposits, which I know they are income. She has her income account as services, so I will add both of those as services. This next one is FIGO pet insurance. Now that is the, I'm assuming, health insurance for the owner's animal, which is clearly not business related whatsoever, which is fine if you do this once in a while. Use the business account for personal transactions, but you just need to make sure when you go and see it in the banking section, you add it to owner's pay and personal expenses so that we know that this is not attributable to the business and it's a personal expense. So I'm going to add that one. This next one is a check. So QuickBooks doesn't have the check images. It's not going to know. And if you don't know off the top of your head what this was, you're going to have to go to your bank's website and just pull up the image of the check. I have that one right here. This is for Monterey Market, and this is just a rent payment for this business. So I would add in the payee because they would get a 1099, and likely they would. And this is rent expense. I would add this one. When you see these two credit card payments for American Express and Chase, it says that they're paired to another transaction. If you see this and it's green, that's good. So because if you think about it, the transaction is happening in the Chase checking and it's happening in the Amex because we're paying the Amex. And if they weren't paired together, this would cause QuickBooks to record this transaction twice, and it would throw off not only the credit card balance, but the checking account balance too. So it's really important to make sure that when we are paying a credit card that is connected to QuickBooks, that those two transactions match together. So if I can see it here in the checking. If I go to the American Express card, I can see it here too. It's the same exact transaction. So we just want to make sure those two are paired together. So these can get added as a credit card payment, both of them. And those ones are done. This, what is this? Oh, this I know is the client's car loan, her business car. It's very important when you're adding a transaction and paying down a loan that we split the transaction between interest and principal. To do that, we're going to go to split, and a portion of it is going to go to pay down the loan, which is going to be this long-term liability car loan. And let's say $255 was getting paid to the principal, and the remainder is the interest. So we would have to split it $255 and $245 here, just so that we know when the balance is getting paid down, it's not decreasing by 500. It's only decreasing by the amount of the principal that's getting paid by that month's payment. So we can accept this one. The next one is a Capital One credit card payment. I know that this business does not have a Capital One credit card, so this was her paying a personal card. So we're going to make sure to add that under owner's pay and personal expenses. And then this last one here for July. This is a Chase ending in, and typically Chase is really nice. You can see the last 4 digits of the card number, which is 2589. And I know that this is a connected account, but for some reason, QuickBooks didn't recognize it and pair it automatically to another transaction. So if I were to add it from this side and then go into that same account, yep, here it is, and add it from this side too without pairing them, it's going to be in there twice. And that's what I was talking about. So we want to make sure it's only once. So to do this, if it doesn't automatically pair, you're going to want to make sure that you have this categorized radio button chosen. QuickBooks a lot of times will push you to hit this record as transfer, but I don't find it very helpful, because if you do add it as a transfer and that's, you think it's correct now, if, you know, tomorrow you say, oh, wait, that's not what that transaction was, it's really, really hard to change it. So I just always as default hit categorize, and then we know that this was the 2589 account. So if I add that one here, and then I go over to the account ending in that, now I should be able to match those two together. So one match found, that's the one that I just added from the other side. And it makes it even easier if I knew what account that was getting transferred to, because I put the last 4 digits of the card in the name of the account. It just makes it so much easier for you and anyone else who isn't familiar with your business to look in and say, hey, I don't know what card this is. What is the Amazon Prime card? If you put the last couple digits, then everyone will know. So we're going to match those two together. And then I'm just going to add all these Amazon because I know that they are office supplies. You can batch select transactions here. And then you can also batch accept them, which is really nice. So then you don't have to sit there and do all of them. So I'm just going to show you guys the Amazon Prime card and the checking for reconciling. So once you have everything added for that month, we're doing July, so this one is irrelevant. We can go to the reconcile tab under accounting. Okay, and we're going to start with the checking. So when everything is added from the banking, that's great and wonderful. But if we're not reconciling our accounts, we don't know if there's anything missing, if any of those credit card payments I was talking about were accidentally doubled, or if anything else for that matter was doubled. So it's super, super important. I would say probably one of the most important things that QuickBooks offers is this reconciling page. You need to do it every single month because that's when your bank gets you a statement is every month. So what we're going to do, you can see that the last one I did was the June statement. So we're going to do July together. I have that one right here. So what we're going to do is first make sure the beginning balance matches the statement and QuickBooks. So we have 12,304.35, 12,304.35. It's typically going to be the same, but I double check either way because you never know. Sometimes it's off. And then all we're going to do to reconcile is I always copy the ending balance. And then I look for the ending date. In this case, it's July 29th. So we have the 1st through the 29th. So all I'm going to do is paste the ending balance in that box, and 7/29 is the ending date. Now, when we hit start reconciling, if everything is correct and we did everything like we were supposed to, QuickBooks should calculate everything for you. Let's see. 907 is missing. This is a good example. Okay, so I'm just gonna get rid of this box. Okay, so QuickBooks says that we're missing $907. What I like to do, sometimes QuickBooks it's not perfect. It doesn't catch everything. So what I like to do is just scroll down here, see if there's anything unchecked. For some reason, QuickBooks didn't recognize this payroll check as getting cashed, but it was because it came through the banking section. We added it. So if I click this, everything is checked and our difference is 0. Let's say that $900 wasn't even here at all. So I couldn't easily identify what was missing, or there's extra stuff in here. I would have to uncheck everything and go line by line from the statement. We always want to compare the statement to QuickBooks because we know the statement is correct. QuickBooks could have made a mistake somewhere, as the user of it, you as well, could have made a mistake. And we need to make sure that we're checking from the statement. So I would start at the top with all the deposits and literally go one by one. I would say 1444, find that one and check it. and truly just go down the line, 103. That's not it, this one. And see what is missing or what is extra and why it's causing your balance to be off. So, 2108. I'm not going to do the whole thing, but that's what you would do to determine what's missing or what's extra. In this case, this is exactly what you want to see. Your difference is 0 and everything is checked. So then we can hit finish now, and it's that easy. It should take you 2 minutes to reconcile each account each month. It should be very straightforward. And the other one I'm going to show you is the Amazon Prime credit card. So credit cards are done the exact same way. It's just a little bit different that they don't typically end on the last day of the month. So I last did the 6/24 statement, and I have the 7/24 statement here. Looks like she paid off this credit card, so her balance is going to be 0, and we're going to use 7/24 as the ending date. So we're going to paste 7/24 is the ending date. And this one looks like it's correct too. We have the balance, the difference is 0, and all of the expenses are checked. If there was for some reason an extra one down here, we would want to investigate why. Is this something I manually added that was supposed to be in a different credit card? Is this a check that you recorded in QuickBooks, but the payee hasn't cashed it yet? There's a couple of reasons. There could be 1 or 2 things kind of hanging out here, but for the most part, a credit card should never. A checking account might. So we can finish this one. And then the other thing you're going to want to make sure you reconcile, besides checking accounts, saving accounts, credit cards, is going to be your loans. So in this case, what do we have? We have this car loan. I don't have the statement for this one, but it's the exact same way. I would find the 7/7 statement and enter all this information, and it should be there because I'm splitting out the interest and the principal. If not, we would have to do some investigating, just like the checking or the credit card. So if you want to add a loan to QuickBooks, we need to create a journal entry. So that's going to be under new, and under other, we're going to choose journal entry. This business doesn't have one that I can add, so I'm just going to do an example. So the journal entry date is always going to be the date that you took out the loan, right? So let's say it was August 1st. The journal number is optional. I typically will write something like, if this was a car loan, do like Chase auto loan, just so we know what it is without even opening it up. So we're going to have to add both the asset or the cash you got and the loan. So let's say that you took out a loan with Chase for $50,000 for a car. We're going to have to credit Chase auto loan. We need to add this as a new loan. So we can just type it in and hit add new. This would be a long-term liability. It defaults to note payable, and we have Chase auto loan. So we can save that one and say the total purchase price was $50,000. And I would just write here, sometimes I keep notes, purchase price. The next thing, what did we get for this loan? What asset did we get? Did we get cash for it? Did we get a vehicle? Did we get machinery? In this case, we got a car. So I'm just going to say, let's say it was a 2022 Chevy Spark. We can add that as a fixed asset because this is a vehicle, and we find vehicle at the bottom. So let's say that this car actually was only worth $48,000. I will just put here. No, this is the loan amount. Sorry, I got that backwards. This is the loan amount. Sorry, and this is the purchase price. And you see that these two don't equal, and your debits always have to equal your credits. That's because the bank just didn't loan you this money for free, right? There are closing costs. and bank fees associated with taking out this loan. So we're gonna say that $2,000 of this was bank fees just to take out the loan. And this is what it's gonna look like every single time. So you're gonna always credit the liability or the loan. You're gonna debit whatever you got. So either if you got cash and it went into the Chase checking account, we would choose the Chase checking here. And then you're typically gonna have bank fees. So I'm going to not save this one. And then we're going to show you also how to run 1099s through QuickBooks. We get a lot of clients saying, you know, I need to run 1099s for my clients. What's the easiest way to do this? I'm telling you right now, QuickBooks makes it so easy to do. So under the vendors tab, which is under expenses, if we click on this one, this is the main vendor screen. If you plan on issuing a 1099 to someone, it's super important to set them up as a vendor on QuickBooks. It's going to make your life easy. So what we need to do is get a W-9 from every single vendor. That just gives us some basic information about them so that we have the information to file a 1099. So the W-9 looks like this. And the bare minimum you need from your contractors is going to be their name, either their personal name or their business name. You need their address, and then either their social security number if they are an individual, or their EIN if they are a business. And of course they need to sign on the bottom. Typically, if they're a business, they'll know to fill out box or 3, check one of these boxes. If they're a C Corp or S Corp, we don't need to issue them anything. But if they're an LLC or an individual, 100 times out of 101, we need to issue them a 1099. So I would recommend requiring the contractor to give you this W-9 back completed before they even start the work. Don't let them work, don't pay them until they give you this form. So to add that all to QuickBooks, we would go to new vendor, and let's add me, for example. So we would say my name, Zaisha Sandwick. We would add my address. And then we also need to scroll down here and add either my social security number or my EIN. I'm an individual, so I would give you my social security number and put it in here. And then we need to make sure that we check this box for track payments for 1099. This is going to be super, super important, because if you don't check the box, QuickBooks isn't going to know to track those payments. And then you're going to have to figure it out that this was the reason they weren't tracking them. It's also a good idea to attach the W-9 to their vendor profile right here in QuickBooks. You can just drag and drop the attachment right here. And if you ever need to reference it again, or they change their address, you can add all of that stuff in here. Okay, I'm not going to save this one. And then you need to also make sure, like I was seeing on the banking screen, we need to be able to track each payment to each vendor. So we need to make sure that this vendor customer is always filled out. So if we were paying me, I didn't add me, but we need to make sure that Zaisha Sandwick is in this box, because QuickBooks can't read your mind. It doesn't know that you paid me this random $220. So you have to make sure you're selecting that contractor for each of the payments that you're issuing to them. And if you don't have all of that information, QuickBooks will let you know when you go to prepare 1099s in January. I can't do it now because it's not ready, but it's going to say, hey, who of these people we've been tracking do you want to issue a 1099 to? If you're missing their address or their social security number, QuickBooks is going to remind you and say, hey, we can't file this for them because we don't have the information. And if you have the the W-9 attached, you can just reference that back and say, oh, I forgot to add it to QuickBooks, type it in quick, and then that problem is solved right there. So the last thing I want to show you guys is going to be this reports tab. Once we have everything added from the banking, we have reconciled all of our accounts, all of our vendors are in there and happy. We can run some reports to see how well our business is doing. I always star these two reports. The first one is going to be the profit and loss. If you scroll to the top, you can choose any date that they have here. You can choose a custom date. You can say all dates. Let's see like how forever this business is doing. Here is all their income. They have some other business expenses. You can see their marketing. You can see what they spent on auto, all their donations. Everything is here, and you can easily see how much you're spending on what in which time period. And we scroll down to the bottom. This is the net income, the money left over after your expenses are subtracted from your income. And the other report that's really good to make sure everything looks good is the balance sheet. So same here, we can change the dates. And then at the top, we have all of our checkings and savings. We have our loans, what's due to other people. We have some credit cards. And then at the bottom, we have the equity section. Anna, did you want to talk about the balance sheet at all?
Yes, I was going to talk about the equity section. So can you scroll down, please? So if you were here for our morning session, or even if you weren't, we talked about an S Corp. We talked about how there should be no long-term rentals, even short-term rentals, to be held in an S Corp. We're not going to really get into the details of why, but essentially is you could end up paying a lot of money if you decide that you have to refinance it into your own name because you get better financing. If you sell it, you also may have to pay taxes on it. So the best thing to do is keep long-term and short-term rentals out of an S Corp. However, if we are looking at a service company, such as wholesaling, if you're a realtor, if you're a broker, if you're a contractor, anything sort of that's active income, that's not from a rental income, we need to keep really, really good records and a really good eye on the equity section right here on the balance sheet. The reason for that, and that's why I say that this is what we need from a tax perspective, is one of the requirements for an S Corp. I'm not going to bore you. We're going to talk about this tomorrow. Is that you have to have payroll. So when you have payroll, there's a line item on the tax return that we go over. Okay, this is how much Anna paid herself on a W-2. It's also going to ask us how much did she take as personal income. This will be on the owner's investment. If you do a comparison between last year and this year, it will tell you how much Anna took out on her that year without paying taxes on it. That number is really important because the IRS wants to see, okay, is Anna really paying herself what she should be paying herself on W-2, or is she paying herself more on the draws section? But also total equity, that number right there that says $69,000, that number can never be negative. So if that number is negative, you most likely will end up paying capital gains on that. Again, very important for the balance sheet. So I just wanted to tell you guys a little bit about why balance sheets are so important and why the IRS is asking us for all this information. So now I will ask some questions. And again, you don't have to worry about knowing all these numbers, right? Because if you do your bookkeeping correctly, we're going to take a look at this. And if you want to have more in-depth conversation, Zay, can you still share your screen, please?
Oh, sorry.
Thank you. Then we'll definitely go into detail of if you have any other questions about your own balance sheet, at least it's there and we can really help you with the detail. So I'm going to go through some questions. Myra asked, if you're doing a new construction, what kind of business would that be? So if you are doing construction, like if you're building houses and then selling them, we definitely suggest that you use the earlier one from this morning, because you need to keep track by class. Also, for flips, you want to keep track by class, because how it works is those work as inventory, right? So we have, let's just say you're building house A, house B, house D, but let's say the end of the year comes around and you didn't sell house D. We need to know that. We need to know because we cannot take any of the expenses that you have for house D until they are sold the following year. But if you're just doing contracting jobs or anything like that, this will suffice. But when it comes to being able to specifically keep track of a single property, like I said, for a flip or for a construction of homes, make sure you have QuickBooks Plus to track by classes. Tara, can you link your bank account to January 2022? That is going to depend on the bank. Most banks only go back 90 days. So what happens is, I'll have Zaisha show you really quick. If you want to go to the banking section and show them how you would manually upload things, since we're obviously in August, they're not going to allow us to go back besides 3 months. So when you go to link account and you put that drop down menu, you will say upload from file. So essentially what you do is you go to your banking and you download it via Excel or via QuickBooks, and then you would save it how it is. And it gives you specific instructions here once you do upload from file. If you want to click on it really quick, Z, it will tell you here how it should be uploaded, right? If Chase doesn't have QBO, then we need to have it in CSV form. And then it will give you a way to structure correctly in Excel so that you can upload it, and they will go to the banking section, and then you have to categorize them again. Honestly, this is what's going to happen with most of you if you have not touched any of your books since this year, because most banks do not go. There are some banks that do, trust me, the big banks are the best. So people who have credit unions, sometimes they don't even link to QuickBooks. So manually having to do it is not as hard, but it's not a quick, put your login, boom, it's done. Andre has a question. How often do you balance your books? What are the best practices? Monthly. Get in the habit of doing it. I mean, if you're on a Friday sitting around doing nothing, open up your laptop and just start categorizing things, but reconciling your books should be done monthly. Do you class owner's investments as a loan? Do you class owner's investments as a loan? I don't understand that question, Tara. So if you want to go ahead and unmute yourself and ask that question, so I can give you a better explanation.
Hi, can you hear me?
Yes, I can.
Okay, so if I have a single member LLC for my business and I'm loaning personal money to the business, is that classed as owner's investment?
Great question. It depends. It's going to depend on, you definitely should be talking to your CPA. Most of the time, it should just be owner's investment. There are times where if you're in a partnership, a loan works best, but if you're just transferring money from your personal to the business, it would be owner's investment.
Okay, and this might be a silly question, but when you say if I sell a property and that money gets repaid back before, it's not considered part of the profit, right?
Right. So if you put, let's say you lend money, or quote unquote, you give money to the company for 50K because you needed that to buy it. Then you sell the property, and from the proceeds, you pay off that loan. You just put it against owner's investment again. So it's essentially in and out. And then any above that would be gain.
That's what I figured. All right. Thank you.
You're welcome. Build to rent. Okay, Myra. Okay, so then in that case, you definitely want to use the previous one, the plus section where you do it by class. So essentially you would use this, what we taught you here, for the beginning when you're building things, but you need to classify them as per property, and they would go on the balance sheet, kind of how we taught you in the AM class. So when you're like, you're starting the foundation and everything would be under cost of goods sold. You're building it, but it will go under the asset class. But you do need classes since you are building homes for rent. Valeria asked a question. Can you give me an example as a realtor when I would require a W-9? You would require a W-9 if you're not an S Corp or a partnership. So now, are your clients that you sell them to going to give you a 1099? No, right? They're not going to. Or I mean, do you mean the other way? You can unmute yourself.
Yes, I meant the other way, like,
okay.
Yeah.
So it really would be for, it's a good question. Let's say that one of your properties, let's say one of the properties that you're selling needs to be fixed, like the plumbing needs to be fixed or something. And you're going to, since you want the property to close, you are going to fix that. Can you hear that noise, Ryan?
No, I
Okay,
heard
good.
something, but it's not there. now.
Okay, sorry. So let's say you hire the electrician just so you can get the house closed and you pay for it and you hire John down the road, you would you would get him a 1099. So it's really anyone that does services for you. Let's say the gifts that you buy for your new homeowners come from, I don't know, a friend that you know that's doing really cute, like welcome home gifts, you would have to give them a 1099.
Okay, makes sense.
Also, when do you recommend paying taxes quarterly? So that's a great question, and it's hard to say in this session because estimated taxes are going to depend if you owe taxes prior years. What are your numbers look like for this year? Do you owe? So if you do owe, I always say pay quarterly. But it's going to be better if you definitely work with a tax accountant to tell you if you are required or not. Unfortunately, this type of QuickBooks does not give you that estimate. QuickBooks Self-Employed does, but QuickBooks Self-Employed is not the best. So keep
Would
that in.
would that be QuickBooks Desktop?
No, so so if you take a look at QuickBooks, see, can you pull up the different types of QuickBooks on Google? I'll show you. QuickBooks Desktop is completely different. I don't know very much about it, so I don't think it even gives you estimated payments. But when you look at QuickBooks, and then Z can share her screen, there's different tiers. The QuickBooks Self-Employed is the cheapest one. I think is maybe like $7 a month. That does allow you, it like gives you an estimate at the top of how much you should be paying for estimated taxes. But that's honestly, if you're just starting your business and it's very basic. So as you see, QuickBooks Self-Employed, that will give you that. But we're looking for plus, right, Z, for the classes?
Classes we would need plus. If you're just doing what we did today, essentials is totally fine.
Essentials or Simple Start?
We can't use Simple Start with our clients because we need access, so I don't know.
Got it. Right. So if you want to so scroll down a little bit for me, Z. Yeah, do the compare online. I want to see something. So keep going down. You might be able to get away with go with this one, go up with the essentials. It seems like there's 3 users, so we might be able to get away with it. If for some reason we can always upgrade, but essentials might be the one. But if you're tracking classes, like we talked earlier this morning, you have to use plus. And although $42 a month may sound like a hefty amount, you guys, it's worth it because it's the difference between you tax planning and not tax planning. So keep that in mind. Let me go to the chat really quick and keep going.
I would say too, if you guys are doing Airbnb arbitrage or you're flipping properties, you're going to want the plus version. So that way you can separate out your different rentals, flips, projects, because you're going to want to classify those. If you're doing arbitrage and let's say you have 5-10 units and you have all the revenue and all the expenses funneling out of say QuickBooks Essentials or Simple Start, you're not going to be able to allocate, hey, how profitable is each unit? You're just going to have a total summary of what's going on, which is fine for tax reporting purposes. But if you want to actually know how profit your rentals are, you're going to want them broken out by property, address.
Yeah, essentially, if you have any rentals, you do need the plus no matter what. And then Raina had a question, and it has to do again with how much should they estimate for paying taxes at the end. I'll give you a simple number if you want to go to it. Obviously, being conservative, I say anything that you make, I always save 30% of what I make. Now, this will depend, right? Because it depends. Are you reps? Are you not reps? Are you married? Do you live in California? There's so many different things that can change how much you will owe. So I guess on the safe side, if you want to save 30% of everything you make, at least that's a better start.
Yeah, there's so many factors, like whether or not you have a spouse, what your income is, what state you live in. It's hard to say. If you wanted to do something more granular, I would pull up a 2022 tax bracket based on your filing status, look to see where your tax rate is, add on about 12% to that for your self-employment tax, assuming you own a business, and that should be your number there too. but 30% also works in most cases.
Yeah, maybe not. Maybe there's more, maybe there's less. It's hard to say. So,
Right.
but this is why it's good, because if you have good books, you should be having conversations with your accountant at least every quarter to see where you're at. So we can help you estimate your projections and how much you should be paying, or even better, what can we be doing to minimize your tax liability? But if you don't have good records or don't know how to help you, like we really, I'm like, well, how much money are you making right now? And you're like, oh, I don't know. I'm like, okay, well then I can't help you, so it really does make the difference between a successful client who saves money versus just clients who are they're just there, and it's nothing against them. I get this is a lot of work, but once you get the hang of it, it's great. And I kind of like Andre's comment. There is a lot of information in these videos, right? And for us, it's easier. So it's like, that's why we wanted to record it, so that when you guys are working through it, you have the follow-up documents. So you can look back at it and feel like you have someone holding your hand through the process. Shamil asked if Stessa is a good alternative for QuickBooks for rental properties. I made a comment earlier this morning, Shamil, that I don't hate it. It's very easy to use. You link your bank accounts as well. You track it by property. The only thing that does worry me about Stessa, I made a comment about how it's free and they allow you to link your bank accounts. So how do they make money is my question. I'm still trying to figure that out. So that just worries me a little bit. But again, at the end of the day, what I'll say is you can get hacked. If Chase can get hacked, so can myself. So it is a good alternative. So if that works for you, and I don't even know if you can do a balance sheet. That's really important. If you can do a balance sheet and if that works for you, use Stessa. We use QuickBooks because honestly, it's, I think, one of the best. Obviously, when you have really, really big things and a lot of properties, we want to upgrade to build them. But now you're really hiring people out. You don't have to do it yourself. So we have about, I would say, 5-10 minutes. If anybody wants to unmute themselves, make comments, ask questions, you really have the next 10 minutes of freebie time with 2 CPAs and a expert here of QuickBooks. If you guys have any questions, comments, concerns, anything.
So you guys talked about the different classes for realtors. Like, I mean, you mentioned S corps. Is that something that you recommend for the real estate industry, or more of an LLC, or what are your thoughts?
So an S corp is, sorry, Ryan, do you want to answer?
Go ahead.
An S corp is an election to be taxed, right? So you usually start as an LLC, Valeria, and then you become an S corp. So I joke with my clients, I'm like, you don't walk around saying, oh my gosh, I'm an LLC taxed as an S corp, right? Like you're just like, I'm an S corp. You usually start as an LLC. Do we recommend it? Maybe, maybe not, right? California, I don't know where you live, Valeria, but California has an $800 annual fee. So if this is your first year and you're not netting any money, I wouldn't recommend doing an S corp or an LLC there, because you're paying $800. We're looking at an S corp. S corp returns are about, I would say they probably start between $2,500 and go up. So me and Ryan had this conversation yesterday, and we said, unless you're netting about $55,000. That means after all your expenses, you have a $55,000 net. That's when an S corp for a business, remember, not for holding properties, is going to make sense, because you're going to have bigger costs, but your savings are going to outweigh that. But it depends also, because New York has a lot of restrictions on S corps. So if you live in New York, I would really talk to your CPA about that.
Thank you.
Yeah, I'll tap in. So general rule 2, any service-based business within real estate. So I'm a CPA firm that focuses on real estate investors. I have an S corp, Anna has an S corp. We just always want to emphasize that you should not have an S corp hold on to your appreciating assets like your rental properties. You would want to just have single member LLCs that are disregarded for those purposes. So if you're a realtor, fix and flip, maybe you're a property manager, you're doing construction, S corps are great as long as you meet those income requirements and you are making sure that you're in a state that is worthwhile. So some of the ones that come to my mind are California, Texas, Tennessee, and New York. Those 4 states, there's little like taxes or higher fees to where you really have to do some more number crunching to see if it's worthwhile. Income requirements, I said between 50 to 60 net income. And I actually, so not to go off too much here, but I'm going to link 2 podcasts that I have. I have one that talks about the S Corp and when you should have it, when you shouldn't. I'll link that right here. You guys can check it out. But about 55 to 60 grand net income is where you want to be. But I would also say, what is your long-term future? Because if you're not going to have that business open for say 2, 3, 4 more years, and you just open it up 1 year, your cost of compliance, like getting everything set up with the state and then dissolution, all those costs is going to be maybe too much to handle. But if you're like, yeah, I'm full-time in real estate, this is what I do for a living, and this is what I foresee myself doing many years to come, and go ahead and do it if it makes sense with your CPA. I'm gonna link this podcast if you're interested in the S Corp. I believe this is the one. We had some comments about fixing and flipping. So I wanted to talk about that a little bit more and like give you guys a real example. So let me know when you guys can see my screen.
We can see it now.
Okay. So the reason why fix and flipping real estate is complicated is because it all depends on the timing. So let's say, for example, Ryan buys a property on August 11th, and he buys the property for, we'll just say $100,000. And let's say Ryan puts $50,000 of repairs in between August 11th and December 31st. $50,000 of repairs. Let's say Ryan doesn't sell the property until his birthday, March 1st of 2023. Okay. He's going to sell the property March 1st, 2023 for $200,000. When does Ryan get to deduct this $150,000 of expenses? We've seen oftentimes clients miss this and they just deduct this entire $150,000 in the year that they spend it. So if I'm doing my 2022 tax return, they would be deducting it in 2022, but that's incorrect. If you're fixing and flipping real estate, all the costs incurred for that property are going to be treated as inventory, and they kind of get siloed and they're pushed off until you actually go to sell the property. So I don't get to deduct this 150 grand on my tax return in 2022. I have to wait until I sell the property in 2023 to then back those expenses out. So on my 2020, like let's say I had no business being in real estate and this one transaction is all I did, my 2022 tax return would be blank. There's really nothing to do there. You might have some general like administrative expenses that you're able to deduct, but the bulk of your cost of your flip and your rehab and your repairs, those are going to be added to the what's known as the cost basis of inventory, and those are not going to be deducted until I actually go to sell. I go to sell the property, and so I want to make sure everybody's aware of that. And Anna, maybe we'll have to do a more in-depth training for fix and flips, but you guys too, think about the timing. Okay. The tax deadline the tax day is March 15th, 2023, right? If I sell this fix and flip on December 15th, the tax bill is due on April 15th versus pushing the sale, whether it's a rental property, a fix and flip, if you can until the following calendar year, it could potentially push the tax burden back 16 months. If selling this property on January 2nd, as opposed to December 15th or December 20th, I don't have to pay the tax for an entire 16 months. So I just wanted to point that out.
Dropping knowledge though, you really went in depth in that. So I appreciate that. I'm going to share my screen really quick. I'm not going to go into detail, you guys, but since we have some time, this is essentially what a balance sheet for a flipper looks like. So when things start going in, you start putting things in your balance sheet. Then you have to make journal entries to move this from your balance sheet onto your P&L. So when you go to the P&L and you look by class, now you start looking at, okay, how is everything going? But it's really nice because let me go to last year, just for example, when we go to last year, it's going to break it out by class and it's going to tell me, okay, this property, I sold it for 310. Here's all the costs. How cool is this? I made 38K in this property. So I would say flips are very complicated. So we'll definitely take a look at this, but the cool thing is that your budgeting is here, right? The client that we work with all the time here, he can look all the time and be like, okay, this is how much money I have in this property. So flips are a little bit more complicated, but they kind of work like the AM session. It's a mix between the AM session and the PM session for flips. So keep that in mind.
And it's super important that you separate out your income, because a lot of us here are, maybe we're working W-2s and we're interested in real estate, or like me and Anna and Zaisha, like we work at a CPA firm. That's an ordinary business activity. So that's generating income. It'd be the same if I was a realtor or a wholesaler or a contractor, right? That income that I'm generating is ordinary in nature. Our rental properties, if we're into rental real estate, that income is classified differently. It's passive income. And we never want to mix the two together. So having separate accounts and separate classifications for, hey, here's my CPA firm income, here's my rental property income. We want to make sure we keep them separate.
Well, guys, I hope this was not super boring. We tried to keep it at least an hour because, like I said in the AM session, this can be a little overwhelming and your brain can start thinking about other things. So you guys will get this recording by next week. We'll be sending this recording to whoever got it, and whoever purchased the recording for all of them will get all the recordings along with our documents that we're going to send to help you give you guidelines. I think that's all I have. Does anybody else have anything to say? Otherwise, can go eat lunch or drink a beer, whatever you want. Tomorrow is so going to be great. So if you didn't sign up for tomorrow, you guys, we have an attorney. We have a 1031 exchange tomorrow. It's going to be a long day, but honestly, the knowledge, I'm excited because I'm like, am I going to learn something new so I can like pay less money in taxes? The knowledge that you're just going to get is going to be great. So whether you attend or you have the recordings, I'm telling you that if you put all of this together from today and tomorrow, you're going to be a better investor and in a better shape to implement all of the strategies that people talk about that are like, how is this person not paying any taxes? They have good books. They have a good badass CPA who tells them what to do. And then boom, they play the game. So make sure that hopefully you guys are all joining us tomorrow.
Anybody have questions? Any last minute parting thoughts?
I have a question.
Sure.
So I have a soon-to-be client that's got flips, that's doing her own remodeling, construction, and it's got rental properties, and she has them all on QuickBooks Desktop. I try to recommend to her that to have them all in QuickBooks Plus, but each as their own.
Yes, is she the only owner?
No, she's got another owner with the remodeling company. The rental properties and the flips are her by herself.
So I think you can put the rental properties and the flips in the same one since she's the only owner. She just have to track it by class. However, as soon as you insert another partner or another owner, completely different, they don't want that partner to have access to their other books. So I would say one for the flips and the rentals and one for, however it is, one for the one that she owns and one for the one that she has a partner with, completely different. And you guys, QuickBooks Desktop, a lot of people use it. I just think nowadays, there's no way we can access it. And that's the hard part. So QuickBooks Online is just so much easier.
I have another question. She's going to also start a developing company where she does doing like outlet malls and building her own multiplexes and all that. But I have to be also on another QuickBooks Plus.
Here's the thing, if she's the only owner, you can keep it on the same one and track it by class, because you can track income by different by class, and the balance sheet can also be tracked by class. However, she needs to have a really good accounting or bookkeeper that can keep track of this, because if there isn't, then that's going to just a shit show. Like, I'm sorry, but that is really going to be horrible. So either have a really good or just separate them all.
Yeah, not too similar, but like I have 3 to 4 different income streams within my CPA firm. Like I have obviously I have consulting, preparation, advisory services, and then education boot camp. So like I have mine broken out, and then speaking engagement. So I have, even within one QuickBooks account, you can have it broken out 5 different activities based on what the client is doing. Like Anna said, as soon as she adds a partner on there or like somebody else into the deal, into the mix, want to separate that out, probably get a new account for that. So that way that person can't see their information or back and forth.
And those are the subclasses that Z was talking about. They're so
Yeah.
great. So let's not overcomplicate things, but also let's not just dump everything into one. All right, Sean. I don't.
Yeah. Also, guys, real quick, those podcasts I was telling you about, I just put it in the chat. They're free. So just if you go on Spotify, it's the Learn Like a CPA show. I drop podcasts like every week, and those are the podcasts that go more granular to what I was just talking about. So
Education, or what is it? Knowledge is power. So, all right, guys. Well, thank you so much. Go ahead and just dive into your QuickBooks, and I can't wait. If you're our client, so who I don't know whose clients are on here or not, but if you are, and at the end of the year we see bad financial statements, I would charge you 3 times as excess more, okay? Because now you have all the stuff here. And okay, guys, have a great rest of your day, and whoever we'll see tomorrow, we'll see you tomorrow. Z and